Good day, ladies and gentlemen, and welcome to your Q2 2018 State of the Market webcast. All lines have been placed on a listen-only mode, and the floor will be open for your questions and comments following the presentation. If you would like to submit a question at any time during the webinar, you may use the chat box located on the lower left corner of your screen. Simply type your question into the box and click on the send button. If you should require assistance throughout the conference, please press *0 on your telephone keypad to reach a live operator. At this time, it is my pleasure to turn the floor over to your host, Jordan Kahn. Sir, the floor is yours.
Thank you, operator, and thank you everybody for dialing in today for our second quarter webcast on the state of the markets. Hopefully everybody can see the slides online that we're going to go through. And as always, if anybody would like a copy of the slides from today, just email our office and we can send those out to you. So my name is Jordan Kahn. I'm the Chief Investment Officer here at HCR Wealth Advisors. And today we're going to just provide some updates on some things we touched upon last quarter and just check in on the state of the markets, both some of the economic indicators that we're currently watching, check in on the interest rate picture in the bond market, and also take a look at the stock market from a few different angles. So let's get into it. One of the things that or a question that we've been fielding recently is the recent market volatility that we've seen and the pullback this year, does that kind of worry us that it may spell the end of the bull market? And so we thought it'd be useful to kind of put the volatility that we've seen into perspective. So this is a long-term chart of volatility in the market in respect of how much the market has pulled back in any given year. So the red dots on this chart with the red numbers underneath them show peak to trough pullback that the stock market has experienced in any given year. And what you'll see here is that last year, I'm going to circle it, last year from peak to trough, the largest pullback that we saw was only 3%. So pretty rare. The only other time that you saw a shallow pullback on this chart was in 1995. Okay, so we have almost a 40 to 50 year history with only 2 instances where the peak to trough pullback in the market was only 3%. So what's rare isn't necessarily the volatility that we've seen this year. What was rare was last year how little volatility there was in the market. And we know from the market's tendency towards mean reversion, right, or working its way back to the averages, that usually periods of low volatility are followed by periods of higher volatility. So the fact that we came into this year and the market started off on a little bit more volatile note, again, doesn't really stand out to us as being odd. It really is, pretty normal. And especially as you get into the later cycles, the later stages of the economic cycle or the bull market, volatility does tend to pick up. Okay? Another question that we often hear is, well, what about valuations? Is the market trading at valuations that are too rich or too pricey? And so what this chart shows is the current, this is a chart of the forward PE ratio, or the price to earnings ratio of stocks. And it's pretty much one of the more popular tools in terms of looking at valuations. And what we see is today, stocks are trading at about 16.4 times earnings. Okay? In terms of how that compares to the average, if you look back at this dotted line here in the middle, you'll see that right now stocks are really in line with the 25-year average. So pretty fairly valued, not really overvalued, not tremendously undervalued either. But the fact that valuations don't seem too stretched right now does tell us that there probably is some room for expansion. Okay? The other thing is, in a couple months when we get into the back half of this year, investors are going to start to look towards 2019 earnings estimates to kind of price stocks or to gauge the valuation of the market. And right now, if you look at where the S&P 500 is trading on 2019 earnings, it's a little under 15.5 times earnings. So by that measure, the stock market is still pretty cheap, and we think that as stocks start to work their way out of this correction and work their way higher, that again there is room for this PE multiple to expand and to help drive the market higher. So let's look at some of the positive indicators for the market that we talked about. One of them, and probably the most positive thing we have going right now, is this strong earnings tailwind that the stock market is experiencing. What you see on this chart, the orange line is a chart or a line of the S&P 500 index, and this dotted line underneath it is representative of the forward earnings forecast or earnings estimates. And so what you see on here is last year, this nice uptrend that stocks experienced in 2017 was really fully supported by a coincident uptrend in the underlying earnings estimates. So as stocks were going higher, earnings estimates were also going higher. And that means that there was a real fundamental reason pushing stocks higher, right? It wasn't like stocks were just going up without a commensurate move in the underlying earnings. And even if we look towards the end of this graph, in the January period of this year where you had this really sharp rise in stocks, again, you see that that sharp rise was accompanied by an equally sharp rise in the earnings estimates. And the reason why the underlying earnings estimates turned so sharply higher right around this time was that this was really in a reaction to the job cuts that were passed. And so what we saw last year is that even though there was a lot of talk about the proposal for job cuts, analysts hadn't really started to price this into their earnings estimates until it actually became law. So as soon as the Jobs Act was actually passed, or the tax cuts were actually passed, then the analysts kind of scrambled to factor that into their earnings estimates. You saw this sharp spike higher, and stocks rose at the same time. So it was kind of a bit of a delayed reaction to the tax cuts. But, you know, one of the other things that you can see on this chart is that on the far right-hand side, even though stocks have started to pull back, the earnings estimates have continued to move higher. You know, week after week, they continue to inch higher. And so you still have this strong earnings tailwind for the stock market that is likely to remain in place for the remainder of the year. The other thing that's not on here, but is another positive factor for the market, is we have seen tons of announcements about increases in both dividends and buybacks. So one of the things that you probably heard about is this Repatriation Act, where companies that have money sitting overseas can now bring that cash back, pay a reduced tax rate on it, and use it for more productive purposes rather than just leaving it overseas to avoid paying taxes. And so what we've seen already is that hundreds of billions, maybe even trillions of dollars is going to come back into the U.S. From these big corporations and be put to work. You know, Apple already announced that they're bringing back $245 billion, and they recently announced that $100 billion of that is going to be earmarked for dividends and buybacks. So we're likely to see this continue to play out as this year unfolds, and that should be another tailwind that should support stock prices. Okay, this is just a snapshot, what's called an earnings scorecard as of last week. And one of the things that I wanted to highlight on here is that currently, even though we're still in earnings season, we've already seen maybe 75% of the companies report earnings. And what this chart is looking at is companies that report earnings, have they exceeded estimates, matched estimates, or missed the current consensus estimates? And so at the bottom, what you see here is so far, 78% of the companies that have reported have exceeded estimates. And that is actually the highest number that we've seen since this bull market began. So going all the way back to 2009, this is the highest number of companies that are exceeding estimates that we've witnessed. So again, just a really strong positive trend towards the underlying earnings that are really the true driver of stock prices. Okay, let's look at some economic indicators. This is a chart of what's called the leading economic index, and this is an index that has a number of components in it that historically have acted as good leading indicators, meaning that they do a good job of forecasting the economy ahead of time, as opposed to certain things like the unemployment rate or GDP figures. Those tend to be more coincident indicators. So as you can see on here, the gray bars, these shaded bars, these are the economic recessions that the U.S. has experienced. And what you'll notice is that prior to each of the recessions that are on this chart, you usually see a topping pattern in the LEI index. You see it top out and then roll over prior to the onset of recession. So right now, the LEI is still moving higher and hitting all-time highs. So we haven't seen any peak yet in the LEI index, and we would likely, as we monitor this, we would likely see a peak here and this index actually roll over before we would start worrying about the onset of a new recession. Okay, so this is still signaling strength ahead. Another one that we like to track is consumer confidence. Okay, so what you can see here is that consumer confidence also is hitting new highs. Right now, the latest consumer confidence index hit its highest level since the year 2000, so really showing a lot of strength. And the reason why we track consumer confidence is that consumer confidence tends to correlate fairly well to consumer spending, right? So strong consumer confidence lends itself to stronger consumer spending, and since the U.S. economy is roughly 2/3 driven by consumer spending, right, this is an important correlation to follow. So again, this is another positive sign for the economy. And what about the state of the consumer? You know, as consumers get more confident, oftentimes in past cycles, they've tended to add on debt, right? Take out larger mortgages, use their credit card more, you know, do things that cause household debt to go up. Currently, though, consumers are actually in very good shape. What this chart at the top is showing the percentage of household debt as a percent of disposable income. So you see right now, with this household debt service ratio down to 10.3%, this is actually about a 40-year low. And it really stands in stark contrast to the peak that we saw at the end of 2007 when consumers were much more indebted. So this lends itself to the fact that consumers are in good shape. They've done a good job about paying down debt on their personal balance sheets. And this likely means that there's probably less risk to consumers when we do head into the next recession. Right? One of the reasons why the last recession was so deep is that consumers were very heavily indebted going into it, and thus they had to, you know, pull back on the reins in terms of spending that much more. Okay? Let's turn to commodities. So commodities are another asset class that we monitor because they tend to be very economically sensitive. So one of the things that we see here is in this longer term chart that right now, if you look on the far side here, right now commodities are just starting to break out from this roughly 2.5-year sideways consolidation. And the reason why that's notable is that, again, as I mentioned, commodities tend to be very economically sensitive. So if the commodity market was concerned about economic weakness ahead, then what we would likely see is that this index would start to break down rather than be breaking out. If you look on the left side of this chart, back in 2015 when things were slowing down, you see this commodity index was moving sharply lower. So right now the fact that it's breaking out to the upside really means that the commodity markets are signaling more chances of reflation or economic growth than they are concerns about recession. All right, let's turn to interest rates and take a look at the bond market. Another thing that we hear tons of recently, if you've turned on CNBC in recent weeks or opened the Wall Street Journal or the finance page of the LA Times, is that there is almost incessant talk about this 3% level in the 10-year Treasury market. Okay, it's almost as if, you know, nothing else really seems to matter in the markets right now other than this 3% level for bonds. But the fact of the matter is that this 3% level, it really is not some sort of magic line of demarcation, right, between good and bad markets. It's just another round number that the bond market has seen before, even though it's been a few years, and that we're back to now. But the fact that bond yields have been rising recently is really a sign that it's just reflecting the economic strength we've been seeing. So as the economy continues to strengthen, we would expect the bond market to reflect this in the form of higher yields. Another thing is if you look at the red line on this chart, this is the last time, or this is the line marking that 3% level. And what you see is in late 2013 and early 14, the last time that bond yields were up at 3%, they didn't get above it. They ran into resistance and pulled back from there. So this time around, the economy does seem stronger. So we think that ultimately we will get above this 3% level, but it's likely not going to come in a straight line. It's more likely that bond yields struggle with this level for a while. Maybe they pull back a little before eventually moving higher. And as long as bond yields, again, move higher, reflective of the strength in the economy, if they move higher gradually, then I think the market's going to be fine with it. The market really only gets, the stock market that is, really only gets concerned when bond yields start to rise too rapidly, which we don't think we're going to see this time around. And one of the reasons is the inflation picture. So this is a chart of two popular inflation readings. One is the CPI, and the other one is the Fed's preferred measure of inflation, which is this PCE deflator. Okay? And so what you can see from this chart is that inflation has been pretty well contained. Okay? The most recent reading in this PCE deflator that the Fed likes to look at is 2%. Okay? And what the Fed said a long time ago, when the Fed started its asset purchases, right, what has been known as quantitative easing, one of their goals was they wanted to get inflation back to 2%. At the time, inflation had really been lagging, and there was a lot more concern amongst the central bankers and amongst our Fed that the U.S. economy might struggle with deflationary pressures. Okay? And since central bankers at all costs usually want to avoid deflation, they embarked on this quantitative easing and they used their balance sheet to do asset purchases with the ultimate goal of getting inflation back to 2%. So the fact that we've recently seen inflation start to firm and reach their 2% target actually should be viewed by investors as somewhat of a sigh of relief, right? Because, again, the Fed went through this period of quantitative easing. They set this goal to get inflation back to 2%. So now that it's there, it's actually a sign that they have achieved their goal. If inflation never got back to 2% and started going the other way, that would probably be a much bigger concern for the market. This chart is a chart of the expectations by the market and by the Fed itself of the pace of future rate hikes. Okay, so what you can see on here is currently the short-term rate that the Fed sets is about 1.63%. The Fed expects that at the end of this year, the federal funds rate will be at 2.13%, and by the end of next year, up to 2.88%. So what's notable about this is that the Fed has continued to keep its rate increases gradual, and also it's tried to be very transparent to the market. And this is different than a lot of Federal Reserve regimes in the past, where in the past it was much more of a surprise when the Fed would raise rates. Investors never knew by how much or for how long. And so this time around, the Fed has really tried to be much more transparent and lay out this steady path which they're going to see rate hikes. So this allows the market to do a better job of pricing these things in. As I mentioned a couple slides ago when we were talking about the Fed's quantitative easing, this is a chart of just exactly the timeline that the Fed did all of these asset purchases, what's known as quantitative easing. So back in 2008, the Fed's balance sheet was less than $1 trillion. Remember, they did 3 rounds of quantitative easing. They had QE1, QE2, and QE3. So by 2014, the Fed had expanded their balance sheet from less than $1 trillion all the way up to $4.5 trillion at the peak of the quantitative easing. And again, this was done, one, to help keep interest rates lower as the economy was regaining its footing, and also to try to get a little bit of inflation in the economy going and avoid deflation. So central banks are really good. They already have a playbook for how to deal with inflation. They just raise rates and slow things down, and that tends to bring inflation back down. But there isn't a good playbook for how to deal with deflation. If you think about Japan and the lost decade that they went through, dealing with deflation, the Fed really wants to try to avoid that at all costs. So this was the 3 rounds of quantitative easing that we saw. Then it came to an end, and now what the Fed is doing is allowing these assets to roll off of their balance sheet and for their balance sheet to start to decrease. So that's why we titled this slide from quantitative easing to QT, which is quantitative tightening. So it's another factor in monetary policy that as the Fed's balance sheet shrinks, it's the equivalent of them tightening monetary policy in another way. But the reason why it's important for the Fed to allow their balance sheet to shrink is really so that they have a cushion in the next downturn, right? Because once the Fed has introduced this policy tool into their array of tools that they use, it's likely that in the next downturn they may resort to it again. So the Fed wants to be able to shrink the balance sheet now when things look good so that if they need to embark on future asset purchases during the next downturn, they will have room to do so. You could kind of make the same argument about the interest rate hikes, right? Right now, while things are looking good, the Fed wants to keep hiking interest rates so that in the next downturn, it has room to cut them again if needed. And last thing in the credit markets that we want to look at is what we call the high yield spreads. And this is looking at the yields on high yield bonds, the most risky bonds in the market, compared to treasury bonds, which are the safest bonds in the market. And what happens is when the credit markets start to get concerned about a slowdown or concerned about the economy or even just the strength of the corporate market, you start to see this spread rise like we saw here in 2015 and into 2016. Right now, at this end of the chart, we're really seeing the opposite, that the credit markets are very calm right now. There isn't really any signs of stress, so things are still looking good. And the reason why we monitor this one closely is that this indicator in the credit markets tends to lead equity markets. So if we start to see a breakout in the high yield spreads, that would kind of be a yellow flag to start looking more closely at the stock market for a potential top and that sort of thing. All right, let's get into some sentiment indicators and turn to the stock market now. So one of the things that we talked about last time that we have an update on is fund flows, or the amount of money that's flowing into stock funds versus equity funds. Now I know these numbers on here came out kind of small, but I'll just run through it for you. The column here on the left, this is the amount of money that's flowing into equity funds, and on the right-hand side, we have the total amount of money that's flowing into bond funds. Okay, so what you see is in 2016 there was actually $72 billion in outflows from equity funds, while you had $190 billion flowing into bond funds. Last year in 2017, which was a very good year for the stock market, you had $186 billion flowing into stock funds, but more than twice that amount flowing into bond funds. And we've seen the same thing so far this year, $28 billion into stock funds, but more than twice that amount flowing into bond funds. So over the last 2+ years, we've really seen about 5 times the amount of money flowing into bond funds relative to equity funds. So quite a big discrepancy. In recent years, as interest rates have been going down, this has worked fine, right? Because bond investors have enjoyed slow and steady returns in the bond market. But as interest rates now start to go up, that tailwind is now becoming a headwind. And so far this year, we've seen that the aggregate bond index, or the total bond market, is down roughly about 2.5% year to date. So it's possible that some of the recent investors in bond funds who just anticipated having positive returns every year, if they start to open their statements and see some negative returns on them, it might be disconcerting, and we could see at some point some of these fund flows reverse from bond funds back into equity funds. And so that would be supportive of stocks. Another thing that we look at is investor sentiment in the market. So we track a number of different surveys to gauge the investor sentiment. And here is an array of some of those surveys that we follow. So the Investors Intelligence Survey, this is a survey of newsletter writers. And you can see that we track the spread between the number of bulls in the survey minus the number of bears. So recently that bull-bear spread hit its lowest level since November of 2016. And that date's notable because that was the period just leading up to the election when there was a lot of uncertainty in the air and, as you would expect, a lot of bearishness. The AAII survey, this is a survey of individual investors, and it's showing similar things. So the bull-bear spread recently hit 2-year lows there. The Market Vein survey, which is a survey of future traders, again, bullish percent there recently hit the lowest since November of 2016. The NAAIM survey, this is a survey of active investment managers. There we recently saw the lowest sentiment since February of 2016, so going all the way back to the last time that the stock market had a 10% correction. And this, what's called the Fear and Greed Index, which is tracked on the CNN Money website, this index actually showed the most extreme levels of fear dating all the way back to August of 2015. That was the summer of 2015 was when China devalued the yuan in a surprise move, and the equity markets again experienced a pretty quick 10% pullback on the heels of that. So taken in total, investor sentiment is fairly bullish right now, and from a contrarian perspective, we view that as a bullish sign because what it really means is you've heard us talk about this wall of worry, right? There's an old saying out there that bull markets love to climb a wall of worry. And so the fact that investor sentiment is so cautious tells us that that wall of worry is still standing pretty tall. And there's a myriad of factors that you could cite as the cause for this quote-unquote wall of worry, right? There's the recent trade wars that have been in the news so much. There's concerns about budget deficits, concerns about global growth slowing, interest rates rising, corporate earnings nearing a peak, and even today, the U.S. pulling out of this Iran nuclear deal. So there's a number of things that are potential concerns out there that are keeping investors cautious. But from a contrarian perspective, that's a good sign because it usually means that there's a lot of cash sitting on the sidelines that could come into the market as bullish sentiment eventually starts to turn. Let's go to the technical backdrop of the market, so looking at the charts. This is a current chart of the S&P 500, and one of the things that I wanted to point out was at the top of this chart is something called a relative strength index. And this shows when the stock market is overbought or oversold. So when it gets above this solid line here at the top, that's an indicator of when the stock market is overbought, meaning that buying pressure has been outpacing selling pressure for a long period of the market. And this is what we saw coming into this year. So in the January period, you see markets hit nearly record overbought levels as the stock market continued to go up and up in January. So eventually, this has to come to an end, or stocks need to have a rest. And so eventually that happened. The stock market ran out of steam in January, and then you had this correction or this pullback in the market. So remember, it had been about 2 years since we had seen a 10% pullback in the market. So stocks were really overdue for this kind of pullback, and the fact that we got so overbought in January just made it more likely that it was going to come to fruition. So the stock market experienced this pullback. It was a pretty textbook pullback. We had a 10% correction, but if you look down here, it stopped right at the 200-day moving average, which is a pretty good area to look for support. Then we saw stocks bounce, come back down in early April, and test this 200-day line again. Right? From there, we had another bounce, trading sideways, and now markets are looking to break back out above these levels again. So this was pretty textbook in terms of how a correction goes. It's positive that the market came down and held above this 200-day moving average, and each time the market came down, you see that it held at higher lows. So it wasn't like the market was breaking down to new lows each time that we had these pullbacks. And when investors think of correction, usually they only think of corrections in terms of price, what percent the market pulls back. but also there can be corrections in terms of time, right? So sometimes when the market goes through a correction, it just needs time to kind of work off the prior gains or the overbought condition. And so we think that's kind of where we are now, that for the last couple of years, pullbacks were very, very brief, and we saw the market snap back quickly. This time around, it's likely to take a little bit more time for the market to work off its gains from the last couple of years, but ultimately we do think that this consolidation will be resolved to the upside and stocks will work their way higher. This is another way to look at this recent consolidation or pullback in the market. And so these trend lines that are drawn here, this really outlines a technical pattern that's known as a triangle or a wedge pattern. And what it's depicting here is the fact that in the beginning you had very wide swings in stock prices when the correction first started, but over time the swings start to narrow and volatility becomes more and more narrow as the correction drags on. At some point, the lines start to get so close to each other that the market is going to have a breakout one way or the other. And more often than not with these patterns, the breakout tends to come in the direction that the market was going before the pattern started. So you can see the market had been in an uptrend before this triangle pattern started, which lends itself to, well, nothing is set in stone, but it lends itself to the notion that more likely than not, we'll see a breakout to the upside. And that's kind of the way that we're leaning. That with all the positive factors that we went through today, we really think stocks will ultimately work their way higher, and even if it takes till the second half of this year, that we're likely to see new highs in the stock market at some time. So just to recap some of the positive factors that we went over today, we saw the strength in the economy. We looked at the LEI index that was hitting new highs, the strength in consumer confidence that was making 18-year highs. We showed the inflation picture where there was really just moderate inflation. Looking at investor sentiment, we see that the wall of worry is still firm, which is often a bullish sign for stocks, that there's ample liquidity, right, with the fact that bond funds have been seeing much more of the inflows in recent years relative to stock funds. The strong earnings tailwind that still looks to be firmly in place. Additionally, we have billions of dollars or hundreds of billions of dollars that's going to come into the market in the forms of dividends and buybacks that should be stock market friendly. And then lastly, we have this positive technical setup. So all of those things keep us on the bullish side of the equation for now. Again, we still think that markets are likely to work their way higher in the latter half of the year. And the last thing that I will leave you with is this quote. You've probably heard me say this before. This is a famous quote from one of the all-time great investors, Sir John Templeton, who said that bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So while there's probably some argument that maybe we've seen some optimism so far, like in the January period, there's very few signs that we've actually seen any euphoria so far in this market. And while it's not set in stone that we have to see a euphoric phase before all is said and done, it does tend to happen more often than not that as bull markets wear on, you do kind of get into this euphoria stage where stock prices really have a strong run higher before they eventually peter out. So that's what we still think lies ahead. We've outlined all the reasons why we remain optimistic on this market. And with that, I will turn it over to the operator and take any questions that callers may have.
Thank you. The floor is now open for questions. If you would like to ask a live question, please press star 1 on your telephone keypad at this time. You can enter your question using the chat box in the lower left corner. Just simply enter your question into the box and hit the send button. Okay, our first question says, are you worried about the extended age of this bull market?
No, I wouldn't say that we're worried about the age of the bull market. I mean, certainly we are in an elongated cycle this time. One of the reasons is that because the Fed kept interest rates so low for so long, this cycle has lasted longer than most cycles. But there isn't a definitive age or a definitive number of years that would cause the bull market to end. What really happens in most cases is that as the Fed raises interest rates, at some point they raise interest rates high enough that it kind of cuts off credit to the economy and thwarts economic growth, and then we start to see things roll over. So I don't think we're there yet, and again, some of this really depends on the pace with which the Fed continues to raise interest rates.
Okay, our next question is, are rising oil prices a concern for consumers?
Well, yeah, I mean, at some point, if, we've seen oil prices rise a fair amount already this year. Today or this week, oil prices touched on $70. But the prices at the pump haven't gone up too quickly. So I think if prices at the pump did continue to go higher to the point where, there was some sticker shock on the part of consumers, that would probably cause consumers to rein in their spending a little bit, which would dampen some growth in the economy. But I think right now what you're seeing for the most part is that oil prices have been moving up because the global economy continues to be in good shape, and thus global demand for oil has been high. But the other thing is this time around, the United States has turned into a huge producer of its own in terms of its ability to produce oil. And so I think that will probably keep a lid on things. And so I guess I'm not overly concerned about runaway oil prices causing a downturn in consumer spending.
Okay, we have a question from Chris. It says, when you speak of the wall of worry, one unusual element is the political news cycle. What are your thoughts on how the market responds to the rapidly developing political news cycle about the president?
So, yeah, that's an interesting comment. And so when you talk about things that hit the market or that can hit the market, there's really two different, I guess, things that we look at. One is something that can affect the underlying fundamentals of the market, right? Something that can actually drive earnings lower, such as a recession or something like that. And the other thing is just what we call noise. And so the news backdrop, negative news comes out, oftentimes it can affect the market negatively, but usually just for short periods, right? And so as long as the underlying earnings growth and the underlying fundamentals remain strong, then markets usually shake off this news and bounce back fairly quickly. I mean, if you looked at a chart of this whole bull market, you would see tons of little pullbacks, but as you sit here today, it'd be very difficult for you to remember what was in the news each time that those pullbacks occurred, right? But you still tend to see it over and over again. Something negative will come out in the headlines, whether it's about the president or a tweet or policy or something like that. It'll affect the market for a few days, and then at some point investors will return their focus to the underlying fundamentals, and stocks will work their way back again.
Okay, and this looks like our final question. It says, is there a certain level in the 10-year yield that would worry markets?
So in past market cycles, oftentimes it wasn't so much the 10-year yield, but it was where the Fed raised short-term rates to. And a lot of times in past cycles, once the Fed raised rates all the way to 5%, usually that was somewhere near a peak. This time around, since we are in a lower interest rate environment, we probably have to discount that 5% rate down a little bit and maybe call it 4% in this cycle. But again, with the chart I showed, that the Fed funds rate is currently around 1.65, I think. We still have a ways to go before we're anywhere near that 4% level.
Okay, and it looks like that was the final question.
Okay, great. Well, thank you, everybody, for dialing in today, and we look forward to hosting another one of these next quarter. Thanks, operator.
Thank you. This concludes today's webinar. We thank you for your participation. You may disconnect your lines at this time, and have a great day.